NFTs. NFTs, non-fungible tokens, are the wild, wild west of digital ownership, turning memes, tweets, art, and more into one-of-a-kind digital treasures. They're a blend of tech geekery and collector's flair, making headlines with eye-watering sale prices and baffling the uninitiated. While they offer a digital gold rush for some, betting on the next big NFT can be as speculative as it gets, with values as volatile as a celebrity's reputation. The NFT market experienced its biggest hype in 2021, capturing global attention. But today, it's largely forgotten about, reminding investors of its highly speculative nature and the real possibility of losing their entire investment. Stocks. Stocks are tiny pieces of a company that you can own. If the company does well, the value of your shares can go up, and you might receive dividends. However, stock prices can fluctuate greatly, offering high returns but with higher risk. Historically, the stock market has seen significant growth, with average annual returns of around 10% since the 1920s, making it a compelling option for those looking to grow their wealth over time. Cryptocurrency. Cryptocurrency represents digital or virtual currencies secured by cryptography, offering a decentralized alternative to traditional fiat currencies. Highly volatile, cryptocurrencies can provide substantial returns but come with high risk and regulatory uncertainty. Their popularity has surged due to the potential for rapid growth, with Bitcoin and Ethereum being the most well-known. Investors can also explore newer altcoins for potentially higher gains. Forex trading. Forex trading is the adrenaline sport of the investment world, where you bet on currency movements. It's fast, it's global, and it can turn a quick profit with the right moves, leveraging your bets to aim for bigger wins. But with great power comes great risk, making it a playground for the seasoned pros who can ride the wild swings. It's thrilling for those looking for action, but it's not for the faint-hearted, demanding a cool head and a keen eye for market shifts. Venture capital. Venture capital is the fuel behind many startups, providing the crucial cash injection young companies need to grow. In exchange for a slice of the business, it's a high-risk, high-reward game, as investing in the next big thing can bring enormous returns, but the chances of failure are high. Venture capital is essential for innovation, supporting everything from tech breakthroughs to new medical therapies. Collectibles. Collectibles are the treasure chests of the investment world, where art, wine, vintage cars, and more can turn into gold over time. This quirky corner of the market demands not just money but also passion and expertise, as the value of these items can swing wildly based on trends and rarity. While collectibles can enrich your life in more ways than one, they're a long-term gamble that requires a good eye and a lot of patience. Commodities. Commodities investing includes physical goods like precious metals, oil, and agricultural products. It's known for its high volatility and can be a hedge against inflation or market downturns. Commodities are popular among investors looking to diversify beyond traditional stocks and bonds, with gold often viewed as a safe haven during economic uncertainty. The market offers various investment vehicles, including futures contracts and commodity-focused ETFs. Hedge funds. Hedge funds are elite investment clubs where the wealthy and institutional investors pool their money to chase big returns. They play the investment game hard, using complex strategies, and sometimes borrowing money to amplify their bets. While they can make money in both good times and bad, hedge funds are not for the faint-hearted due to their high fees, aggressive tactics, and the real risk of significant losses. Private equity. Private equity is all about investing big money directly into companies, often those not traded on the stock market. Investors might buy out entire companies, aiming to revamp them and sell for a profit later. This world is known for its high stakes and potential for huge payouts, but it requires deep pockets and the patience to wait years for investments to pay off, making it a playground for the rich and patient. Peer-to-peer lending. Peer-to-peer lending shakes up traditional banking by letting you lend your money directly to others online, aiming for a nice profit in return. It's like being a banker, but from your couch, offering the chance for juicier returns than your typical savings account if you're willing to take on a bit more risk. This modern twist on lending is alluring for its higher interest potential, but it's not without its hazards, like the chance someone might not pay you back, requiring a smart spread of your money to avoid any heartache. Bonds. Bonds are essentially loans you give to companies or governments in return for fixed interest payments over a period. They're seen as safer than stocks, providing steady income with less volatility, but with generally lower returns. Options range from very safe government bonds to riskier corporate bonds that offer higher interest rates. Mutual funds. Mutual funds pool money from many investors to purchase a broad mix of stocks, bonds, or other securities, managed by a professional. This strategy spreads out risk and offers balanced returns, though management fees can impact profits. Popular funds often aim to match the performance of the global market or a specific global index, making them a favored choice for achieving diversified market-wide exposure with a single investment. ETFs. Exchange-traded funds, also known as ETFs, are similar to mutual funds, but trade on the stock exchange like individual stocks. They blend a variety of investments with the flexibility of stock trading and generally incur lower fees than mutual funds. ETFs enable investment across diverse sectors, geographic regions, or investment strategies favored for their adaptability and efficiency. Real estate. Real estate investment involves purchasing property to generate rental income or capital gains through appreciation. It's considered a tangible asset offering potential for significant returns, but with higher initial costs and maintenance obligations compared to other investment types. Real estate can provide a steady income stream and diversify an investment portfolio, with options ranging from residential properties for leasing to commercial real estate for business use. Fixed interest accounts. Fixed interest accounts, like savings accounts and CDs, are the cozy blankets of the investment world, offering a snug and secure spot for your money with set interest rates. These are the go-to for playing it safe, perfect for stashing cash you're not willing to risk, with savings accounts giving you quick access to your funds and CDs rewarding you with higher interest for not touching your money for a while. They're a big hit for their rock-solid reliability, appealing to those who prefer a worry-free approach to growing their savings. Derivatives. Derivatives are financial securities whose value is derived from an underlying asset or group of assets, such as stocks, bonds, or commodities. They include options, futures, and swaps, allowing investors to speculate on price movements without owning the actual asset. While offering the potential for high returns, derivatives are complex and carry a high level of risk, making them suitable for more experienced investors. They are used for hedging risk or speculative purposes in various markets.